Reserve has raised rates again. After a brief pause, rates will go up by 25 basis points, and the central bank is signaling that there may be more hikes, possibly in September. But investors hope this is the last hike for the year. Benji Heyer starts us off from Washington.
Look, this was never really a question of whether the Fed would raise rates or really by how much, but instead a question of if this is the end move, the culmination of the campaign to quell stubbornly high inflation. The bank's 11 straight hikes recently, up more than 5 percentage points since early last year, has helped push inflation down from 9% then, a 40-year high, to about 3% now. Still above the 2% target, yes, yet many traders believe it's close enough for Wednesday's decision to mark the Federal Reserve's final increase of this cycle. Now, Fed Chair Jerome Powell in a press conference earlier didn't publicly signal that, and for good reason. He'll still want to retain the flexibility to tighten monetary policy further should prices fail to continue easing in the coming months.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve.
These changes, however incremental, can over time have a profound impact on the economy, on growth, and on Americans' wallets. Each time rates go up, so does the cost of borrowing for consumers. The Fed's next steps beyond July will ultimately depend on what economic data shows going forward. It says it'll monitor financial markets and global developments closely before its next meeting in September. Benji Heyer, CGTN, Washington, D.C.
And that rate decision could cool down the U.S. housing market, perhaps even further. Data out Wednesday shows that new home sales declined in June for the first time in 4 months, and that suggests that the higher borrowing costs are working to keep buyers at bay. Low housing inventory is also keeping prices high and also slowing market activity. Sales of single-family homes fell 2.5% in June, ending 3 straight monthly increases. The median home price fell 4% on the year to around $415,000. That is still, though, well above the pre-pandemic prices. For a check on how the U.S. markets reacted to this data and the Fed and corporate news, Karina Mitchell has this from the NYSE.
It was another big day for earnings here on Wall Street, starting with Coca-Cola that reported before the bell, and they beat on the top and bottom line. They increased their guidance. Net sales were up by 6%, and organic revenue increased by 11%, largely because they were able to pass on higher costs to the consumer who have been willing to pay over the last 2 years. In the second quarter, prices were up by 10% year over year, but the good news is it said that it has stopped hiking prices in the U.S. and Europe for this year. Over to Boeing, which posted better than expected earnings. Its stock jumped 7%, thanks partly to revenue that came in at $20 billion. That's $1.5 billion better than expected. But the big news here is that demand for its best-selling 737 MAX jet has increased, and it expects to place orders for up to 450 of those aircrafts by the end of the year. Remember, it and rival Airbus have been struggling with demand ever since the pandemic. And then on to Meta, which reported earnings just after the bell, and they beat Wall Street expectations on earnings and revenue. Revenue actually jumped by 11%, in part to an increase in advertising sales, so that was good news for them. They also increased the number of daily active users on Facebook. That went up by 5% year over year, and for the quarter up 3% as well. And they lifted guidance. The stock climbed by 6% after hours. I want to touch base on what happened in U.S. markets. It was a big day because the Fed announced that they would increase rate hikes, but it didn't impact the major averages too much. The Dow actually managed to eke out a 13th straight day of gains. Interesting fact, if the Dow holds on to those gains for 14 days, it will match the longest win streak, which was set back in 1897. The NASDAQ edged lower and the S&P was flat. Now a look ahead to Thursday. It is the busiest day of the earnings season so far. So look out for earnings from Ford, Intel, Southwest, as well as McDonald's. And we will also get that advanced read of second quarter U.S. GDP. Karina Mitchell, CGTN, New York.
For more about what this means for you and I, this 11th rate hike, we are joined by Ted Rossman. He's a senior industry analyst at bankrate.com and also creditcards.com. Good to see you again. So I think the last time we talked about it, we weren't even sure if we needed to do this, but I guess the Fed is going to need to do it, or they did it because everyone expected them to do it. But then the question arises, what happens in September? We'll get to that in just a minute, but let me ask you, did they need to raise rates today? I mean, it's the 11th time, they already did it 10.
That's right. I think it was still the right move. Services inflation in particular, big part of core inflation, of course, remains stubbornly high. If we look at core PCE inflation, the Fed's main inflation gauge, that's been really stubbornly stuck in that 4.6, 4.7 kind of range for really this entire year. So I think that's what the Fed is really looking to stamp out here. I thought Chair Powell had a relatively hawkish tone at the press conference. I think really talking tough about inflation and saying that the job is not done and leaving the door open to potential future hikes as well.
It's interesting because if you look at the market reaction, the market essentially kind of called his bluff to some extent, even though he did say something that I picked up on, which was he did not think that inflation would drop to 2% until the year 2025, which I can barely think about next weekend, let alone 2025. That seems a really long ways away. If people are betting that he's going to cut rates between now and then, they're going to be wrong if you believe Chairman Powell.
Well, there is that adage, don't fight the Fed, right? There's been a divergence for a while now. It actually has narrowed, and then maybe this is coming back into play. But earlier this year, there was a big spread between what the Fed was saying through their words and through their dot plots and really talking tough about raising rates. And a few months back, the market was pricing in multiple cuts this year. Now, that's no longer the case. The expectation for this year, at least from the market, seems to be a plateau from here on out. The Fed's leaving the door open to future hikes. But then next year, now we're sort of having that debate again about the Fed's talking about higher for longer. Investors seem to be pricing in cuts beginning early next year. So it's going to be interesting to see how this shakes out. But I think the timetable of rate cuts has gotten pushed out. I think that the recession timetable keeps getting pushed out. You know, people have been saying for 2 years now that the recession's right around the corner.
What recession? This economy is more on fire than I have recalled, and I've been watching the economy for a really long time. You have low unemployment, right? You have basically full employment. You have a huge number of company formations. You have real estate at their near peaks. You have productivity that's also high. The dollar remains strong. I don't see anything. I don't understand why everyone keeps talking about recession.
Yeah, I agree with you about the glass half full take on things. I mean, some people would say, well, the Fed's going to break something, they're going to push too far. Some people thought that had already happened back in the spring with the bank failures, although it seems like that's been contained and we've moved on from that. You know, some people point to the sluggishness of the housing market and the fact that delinquencies are creeping up, especially on autos, but also on credit cards. And it's that long and variable lag to monetary policy.
I get it.
It's kind of more art than science, I would say.
The smart economists are going to tell us what things could go wrong, but I'm just saying from sitting here in D.C. and flying around the country, people seem very happy. I didn't even mention consumer confidence. Okay, let's talk about what impact this might have on people, right? And I'll get to businesses in just a moment. But for the average person, you and I who have maybe a little credit card debt, maybe a little student debt, how is this going to impact us?
I think higher for longer is the key there. So there is definitely a cumulative effect. The Fed has now pushed rates higher by 5.25 percentage points since March of last year. That directly hits credit card borrowers. It directly hits home equity line of credit borrowers. That's a product that we used to think of as a low-cost debt. Early last year, those rates averaged about 4%. After this rate hike, they're probably going to be close to 9%. On average. Credit cards are over 20% on average. That's where we're feeling it. Also, the housing market, of course. new buyers are really affected by this rise in mortgage rates. We're looking at about 7% now for the 30-year fixed. That rise has trimmed about a third off of home affordability. And it's keeping people staying put in their current homes, because if you have the golden handcuffs of a 3 or 4% rate, you don't want to move.
Let's talk about businesses. I'll just pick out a company. I was looking at Carnival Cruise Lines. You know, the market cap's somewhere around 10 billion. They've got 30 billion in debt. Okay, and while the business itself might be functioning fine, all this debt means they have to pay interest, and as those bonds come due, they have to refinance it, and so as rates go up, the cost of them carrying all this debt gets heavier and heavier. Which industries or what industries might be impacted by this sort of slightly higher rate?
The tech sector has really been feeling it, especially a lot of these high growth venture-backed companies that rely on low rates. Now this year, the NASDAQ has surged by more than 30% after a brutal year last year. So we always have that question about leading versus lagging indicators. But I think on the face of it, tech would be affected. You know, it's interesting you bring up Carnival Cruises, because another thing we have going on here is all that pent up demand from the pandemic. And we have people, despite some of the gloom and doom, saying, we want to travel. We're just itching to get out there. I thought revenge travel would have peaked last year, but spending remains really hot on services and experiences. And I think in some respects, that's making the Fed's job tougher, because there's still a lot of demand out there.
Yep, I think you're 100% right. The public seems fairly content and happy, and they're happy to spend money. Ted Rossman, good to see you. Thank you.
No problem. Thanks.